The meltdown in our economy as a result of the financial scandals has made the growing college affordability crisis worse for many American families. Escalating tuition prices and college loan payments have become even more burdensome in the face of lost jobs, income, and benefits. Students are graduating with too much debt. We as a Congress need to refocus our efforts back on grant aid rather than loans. 20 years ago, the maximum Pell Grant Award covered about half of the in-state tuition. Today, it covers about 30%. Over the last 3 years, we've worked hard to reverse this trend by increasing the maximum Pell Grant Award by $1,500. But work still needs to be done. Today, our committee will examine how we can continue to make college more affordable by significantly increasing grant aid for students. We can do this at no cost to the taxpayers by transforming the way our student loan programs operate. First, it's important to take stock of how we intertwine credit markets. Credit and economic crisis have altered the student loan landscape. For years, the Department of Education has operated two programs that provide borrowers with the same federal college loans at the same interest rates, terms, and conditions. One was the Federally Guaranteed Student Loan Program, or the FELL program as it's known, under which private companies make loans to students and receive federal subsidies. These loans are virtually risk-free for lenders because they get reimbursed by the taxpayers when borrowers default on their loans. The other is the Direct Loan Program, under which the federal government offers loans directly to students using Treasury capital. It's subsidy-free and cheaper for taxpayers. Last year, as the credit markets froze, many FELL lenders had trouble financing their lending activity. Some chose to discontinue making loans, while others became highly selective about whom they would lend to. With many students and families deeply worried about their student loan availability, Congress stepped in to perform emergency triage. Our goal was to make sure that families saw no interruption in the access to loans. We enacted a temporary program that to date has been successful. It allows the Secretary of Education to finance and purchase loans from lenders using Treasury funds. But this was never intended to be and isn't a permanent solution. Meanwhile, seeing that the Direct Loan Program remained insulated from the turmoil in the economy, hundreds of colleges and universities switched to the direct loans for the first time. Two undeniable lessons have emerged from the past year. First, the economic crisis has exposed serious vulnerabilities to the current FELL structure, and students shouldn't have to worry about whether the roller coaster fluctuations of the financial markets will hurt their college opportunities. Second, FELL currently is on life support. In fact, the federal government, through both the Direct Loan Program and its emergency program, are now funding 6 out of every $10 in federal student loans made this year. In short, the status quo has become impossible to defend. Students and families are not being served well as they could be, and taxpayers are spending billions of dollars annually to finance a broken system. The momentum is building for reforms that will deliver aid to families in a more sustainable way, shielded from many ups and downs in the markets. There is already several proposals on the table, and we will take a close look at today. In his 2010 budget, President Obama proposed increasing Pell Grant scholarships by ending lender subsidies and instead using the federal funds to originate new federal student loans beginning in 2010. The Congressional Budget Office estimates that this would save about $94 billion over 10 years, all of which is to be redirected back to the students. I think this proposal sets the bar high. It yields an astonishing savings that will help students make the most sense to the taxpayers and harness the private sector innovation for the public good. We will also hear about other proposals to reform our nation's student lending. While the means and reforms may be different, any workable plan must meet two basic benchmarks. It must increase the efficiency of the loan program so that we have more to invest for our students, and it must increase reliability so that students and families are never again left wondering whether or not where to turn in a difficult economy. We will hear about the experience of one school that entered the Direct Loan Program last year and what other schools might expect under the President's proposal. We'll learn more about students' financial needs and how we can best reform these programs to work on their campuses. Now there are some who like things the way that they are. They've already begun to fight this change, but I think the students who have framed the issue candidly, we either can continue sending billions of dollars to the lenders to act as intermediaries, or we can start sending that same money to the students and their families who are trying to pay for college costs that continue to go up, costs that continue to go up faster than inflation, and that more and more families find themselves struggling with. And I think that's the question that's before us today, is how do we go about providing the best deal for the taxpayers, the students, their families, and the institutions. And I look forward to today's testimony, and I welcome all of the individuals who will be testifying and lending us their expertise and their experience in this field. And